This is Al Brooks, and this is my price action trading course. This module is about trading inside of trading ranges. In a trading range, my approach is simple. I buy low, I sell high, and I scalp. When you buy low, you can either buy to go long or to exit shorts. When you sell high, when you sell near the top of the range, you can either sell to go short or to sell out of longs. And scalp, you want a reward at least as big as your risk. Trading ranges occur every day, even inside of trends. And trading range days, where most of the trading is in a trading range, are also common. All trend days have trading ranges within them. For example, a trending trading range day is made up of 2 or more large trading ranges. And you only trade in both directions if the swings are very broad. Here's an example of a trading range. You want to buy low, sell high, and scalp. You want a reward at least as large as your risk. Okay, so the market is going sideways. We're getting near the top and near the moving average, so reasonable to short below a bear bar. Down here, 3, 4, 5 pushes up. I'm down near the bottom of a channel and a bull bar, reasonable long. A second entry long, or 2 legs down, 1 push, second push down, failed bear breakout and reversal up. Also down near the bottom of the range, possible higher low major trend reversal, possible buy. Micro wedge top, a reversal bar, bull body, not ideal. You could take the first entry or you could take the second entry. A new low below the trading range. Actually an expanding triangle, 2 pushes up, 1 and then 2, higher high, low, lower low, even lower low, and a very big bull reversal bar, worth buying. And you can see what happens even with a very strong bull spike. The market still turns down sharply. Trading ranges are always trying to break out. Strong bull bar, it failed. Strong bear bar, the bear breakout failed. Strong bull bar, strong bear sell-off, strong bull reversal, reversed again. Remember, most breakouts fail. You look to buy a reversal up from a breakout below a swing low near the bottom, and you look to sell a reversal down from a breakout above a swing high near the top. So we have a good bull spike. Here's a high, a pullback, and the market broke out again. We broke out above this swing high, and we broke out above these highs. So you look to sell a reversal down. Here we have a low. The market is breaking out. You look to buy a reversal up. Okay, here we have a new low. You can buy the reversal up there. You have a second entry here. We have a high, a breakout, a reversal down. There's your first entry. You might exit above that. Here's a second entry short. Here we have a swing low. The market broke below it. You could buy here, or you could buy a second entry here. You should look for clues early on that the day might be a trading range day. Yesterday, into the close, we had a tight trading range, lots of reversals, lots of big bars. And then, yes, we sold off here, but we had a tail, another tail, went above a bar, doji signal bar, reversed up, okay, big doji here. So we're in a tight trading range here. And that could be a clue that today would be a trading range, especially since yesterday was a trading range day. So yesterday was a trading range day, had intense two-sided trading into the close, and now we're getting pretty intense two-sided trading early on. So today could be a trading range day. We fell below yesterday's low and reversed up. We reversed up twice. Again, lots of tails, lots of reversals, lots of overlap, bull bars and bear bars alternating, so very two-sided trading. So this looks like a possible start of a trading range day. Well, if it might be a trading range day, the market typically breaks out to the upside and fails. So here we're breaking above a swing high and we have a bear bar, so that's a reasonable short if you want to bet that it's a trading range day, and that's a reasonable bet. When in doubt, you wait for a second entry. Sometimes you don't get a second entry. And this is what the market did after that reversal. Okay, now it's breaking out below the low of the day. But since today is a likely trading range day, you have to assume that the reversal up will test up to near the top of the range, and then it's an okay buy. Especially since when you look at this bear leg, all right, yes, it's a very tight channel, but where are the consecutive bear bars? Where are the big bear bars followed by another big bear bar? We don't have that. We have doji bear bars. We have a bear bar here followed by some sideways bars, a bear bar here, doji, bull bar, bear bars with tails on the bottom. This does not look like a bear trend. It looks like a bear leg and a trading range. So that's also consistent with trading range behavior. Here's that long. The market went up, and now we're entering a triangle. You can draw triangles many ways. You could use this low as the first low. So 1, 2, 3, 4, 5, 6, 7. It doesn't matter. We're in a very tight trading range. We're in breakout mode. Are we near the bottom of the trading range? We're near the bottom of the 2-day trading range. We're pretty much in the middle of today's range. III, 3 inside bars, breakout mode. Traders will look to sell below and they'll look to buy above. Again, more evidence of trading range behavior. Another way to draw the triangle, up, down, up, down, up, down. Another way to draw the triangle, you could start it up there, you could start it down here. It doesn't matter how you draw it, you just need to know that the market is in a very tight trading range and in breakout mode. Okay, the triangle broke to the upside. Traders might have bought above this inside bar. We have an III, 3 inside bars. They might have bought above this bar, they might have bought above this bar. And we have a strong bull spike, but trading ranges often race to the top and race to the bottom. So if you think this is a trading range day, we have a new high and a reversal. It is reasonable to sell on a stop 1 tick below that low. And this is what followed. A race to the bottom. Again, looking more like a bear leg in a trading range than a strong bear trend. Where are the consecutive big bear trend bars? They're not present. So we raced down to the bottom, double bottom with this low, possible higher low major trend reversal. You can view this as a bear trend or a bear channel, and then we have a bull breakout. And now we have a higher low major trend reversal in the form of a double bottom. We have a 2-bar reversal here. I think this is a reasonable buy. And this is what followed. We went above this high, no reversal down. We tried to reverse, we did not. We went above this high and no reversal down. So the trading range day was converting into a higher low major trend reversal. I do think you could buy above here. You probably could buy above here. Another breakout, an II pullback, a bull bar. You could buy above that bull bar as well, trying to capture what appears to be a trading range day converting into a bull trend. And you can also buy a reversal up from a final flag near the bottom. So if you get a bear flag near the bottom of the range, you can wait for the bear breakout and then see if it fails. And if it fails and starts to reverse up, you can buy the reversal up. And similarly, if you get a bull flag near the top, that might be the final flag. You can wait for the bull breakout to fail and then look to sell the reversal down back into the trading range. So here we have a lot of two-sided trading, right? Possible bear leg within a trading range. We have a low too short, right? So a possible final flag. We broke to the downside and we have a bull reversal bar. So this is a reasonable long. We have a bull flag up here. You can call it a wedge bull flag. 3 pushes down. 1, 2, 3. But it's near the top of what could be a developing trading range, just above the moving average. So you can look to short the failed breakout, the breakout if it fails. We broke out and we had a 2-bar reversal. That's a reasonable short, especially since this is a big gap down, a bear trend well below the moving average, and this is a gap bar, and this is a second entry gap bar short. So that's a reasonable short. Second signals, higher probability. So if you're at the top of or bottom of the range and you see a reversal, you can take the first reversal. If it does not look strong enough, wait to see if you get a second reversal. So for example, well, let's talk about this one. This is easier to see. The market fell below the low. It reversed up, not a very good signal. And then we had a second signal here, higher probability. A strong bull spike. Traders might not want to take this signal, especially with that big tail. But then we got a second signal short right here, higher probability. So second reversals near the bottom to buy, second reversals near the top to sell. Trading ranges often have legs that have wedges in them. So if you have a wedge bottom reversing off the low of the range, you can look to buy it. If you have a rally in the form of a wedge near the top of the range, and it reverses down, you can look to sell it. 3 pushes down, 1, 2, 3, in a wedge shape. So this is a reasonable buy, especially with an II and a bull reversal bar. Now we have 3 pushes up, 1, 2, 3. I know this does not have a very good wedge shape, but I think it's still a reasonable short. I probably would not take this short because of these 2 big bull bars, but I do think the second entry makes sense. When the probability is not all that high and you're not certain, then you need to go for a reward that's 2 times your risk, but you always go for a reward at least as large as your risk. Once you determine your stop size, then you go for a profit just as big. And very often you have to quickly convert your target based upon actual risk instead of initial risk. Here the initial risk is above the signal bar, but once you were in the trade, your actual risk was right here. I don't have it drawn in, but this bar went down about 2 times actual risk. Same with right here. Your initial risk is below the signal bar right here, but once you're in the trade, let's say you bought above the bear bar, let's say you bought above the bull bar, your actual risk is here, 2 times actual risk is up here. Experienced traders can quickly determine actual risk and then adjust their profit targets based upon actual risk. So if you shorted below this bear bar, your initial stop is above its high. Once you had this strong bear bar, you could assume you could tighten your stop to above its high, and your actual risk is 1 tick above its high. Your entry price is right here, so 2 times actual risk is here. So traders could exit here 2 times actual risk. And the same with the bottom over here. Let's say you bought above the bear bar. You could do the same argument buying above the bull bar. But let's say you bought above the bear bar. Your initial stop is below the bear bar. But once the market started to turn up, you were able to see that your actual risk was to this point. So you went long at this red line right above that bar. Your actual risk was here. So 2 times actual risk is here, and you could take your profits there. I think for a lot of traders, it takes a little experience to convert to exiting based on actual risk instead of initial risk, but I think that's the best way to do it, and you should try to do that once you have the experience. Getting stopped out often, most traders don't worry about it. They just take the loss and they look to enter again on a second signal. So if a trader took this short and they had a tight stop and they were stopped out here and got a second signal, they would sell again. One alternative to that is to use a wide stop. If you're using a wide stop, you should trade small because your risk is bigger, and it keeps you from getting stopped out of what could ultimately be a good trade. And if you're trading small and then get a second signal, you can put the rest of your position on once the second signal triggers. So let's say you took this short, right, and you were not certain if you picked the exact top. You might use a wide stop, like maybe a measured move up based on the height of the signal bar. So you trade small, you'd hold short when the market breaks above the high of this bar, and then you have a second signal. You can put the rest of your position on during the second signal. Okay, here, let's say you took the second signal. Actually, this is to illustrate limit orders. Okay, you have a bull flag, but it's at the top of what is probably a trading range. So probably more sellers than buyers above. Experienced traders won't take this buy. They won't be buying bull flags at the top of a trading range, especially when we keep getting failures like we are right here. Instead, what they'll do is they'll bet that this will fail as well, and they'll place a limit order to go short at the high of the prior bar. So they would have been filled here. Initial stop, they may have initial stop above the high of the day, and then they would look to take profits, maybe 1 times the initial risk, maybe 2 times the initial risk. In this situation, I think most traders, after this bear bar triggered, they'd tighten their stop to 1 tick above its high, and then they could try to get out at 2 times their actual risk, which would also probably be right around here. If they shorted here and their stop was moved to here by the close of this bar, this would probably correspond to about 2 times their actual risk. If the risk is very small, you should try to go for a bigger profit target, like twice the size risk. So for example, let's say you bought on a limit order at the low of this bar, betting that it would be a bad short at the bottom of a trading range, right? Your initial stop, you might put it below the low of the day. Your risk is very small, so you might go for twice your risk. Let's say you bought on a stop above the bar. Again, you could go for twice your risk. So when you have small risk, you should not go for a target that's equal to only 1 times the risk. You should go for a bigger target. Tight trading ranges, let's say the distance between the bottom and the top of the range is very small, so the range is very tight, and the market has lots of reversals, reversing every bar or 2, and the breakouts above the high of the prior bar are only 2 or 3 ticks. The breakouts below the low of the prior bar are only 2 or 3 ticks. Tight trading ranges, they trump every reason that you can come up with for entering on a stop. Stop entries are losers in tight trading ranges. So beginners, when they see the market entering a tight trading range, I used to refer to those as barbed wire patterns. Beginners should stop trading because beginners should only be entering on stops, and when the market is in a tight trading range, that's the exact worst time to be entering on stops. Experienced traders are doing the opposite. They're buying below the lows of bars and they're selling above the highs of bars. And you can't be doing the opposite of what the institutions and the experienced traders are doing, because you'll lose money. So you wait for the tight trading range to end. It ends after there's a clear and strong breakout, and then you can go back to stop entry trades. Half of the breakouts from tight trading ranges, once you get totally free of the tight trading range, half of those breakouts fail. Sometimes you can enter with a stop entry in a tight trading range. If the distance between the bottom and top of the range is big enough and you get a small bear reversal bar near the top, you can scalp below. If there's a small bull reversal bar near the bottom, you can buy above. So here's an example. We're obviously in a trading range and it's very, very tight. We have a small bear reversal bar near the top, so you could consider shorting that. We have a small bull reversal bar near the bottom, so you can consider buying that. Most traders, if they're starting out, should not take a chance, and they should just wait. This is what I was talking about. You could short below that bar for a scalp or buy above this bar for a scalp, even though the market's still in a tight trading range. As I said, experienced traders and institutions will take scalps using limit orders. They'll sell with limit orders to go short above the highs of bars, and they'll scale in higher, and they'll buy with limit orders at the low of the prior bar and scale in lower, and they'll just be scalping. So here's an example. The blue boxes are where experienced traders will be shorting above highs of prior bars. The green boxes are where the experienced traders and the institutions and the computers will be buying. They'll be betting that the breakouts will fail, and they'll be right almost every time. So when they're finally wrong, whatever they lose on that last trade will not be enough to erase all that they made on the earlier trades. Most traders should not do this. It's very difficult to do. It's draining, and the reward is not all that great. Best thing to do is wait for a clear breakout and wait for the market to turn more into a swinging type market where you can enter on stops and try to get swing profits. And I mentioned that some traders will scale in. Okay, so if a trader bought the low of this bar, okay, maybe they'll buy again 1 point down and buy again 1 point down, right, and use a wide stop. However, once they had this strong bear breakout and they're long, they're probably going to be happy to get out break even. So they'll probably place a limit order to get out break even on the trade, which would be right around their second entry. So they lose a point on the first entry, they make a point on the third entry, and they get out break even on the third. And again, this is all hard to do, and you have to make decisions very quickly, and I think it's too much to expect people to do when they're just starting out. And that is the end of the module on trading within a trading range.